Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement. Sam, say hello.
John, how are you doing?
Sam, I'm doing okay. Believe it or not, even after the last week or so that we've had in the markets with all the turmoil that we've had, I'm doing okay, and I'm doing okay because it's a beautiful day here today in central Alabama, and I'm getting ready to go travel to see my boo up in Chicago, and as she trods the stage or whatever they call it up at the Second City. So I'm doing great.
That is a nice silver lining with a lot of blood in the streets for the markets.
That's a nice silver lining. But when I sit around and take a look at everything, I'm glad I've got that silver lining. A lot of people don't have that silver lining. And Sam, I know you've gotten the same questions I've gotten this past week from coworkers, from prospects, from clients. Just what in the hell is going on in the markets? What's going on in the economy? And when is this going to end?
Well, what's been interesting about this is how quickly the market pulled back. I mean, it's one of the quicker ones for a 10% pullback.
Yeah.
But beyond that, there's this kind of political component to it that people on both sides of the aisle that maybe don't care about the markets typically are focused on them. So, you know, you have those people that are always freaked out about pullbacks in the market, but then you have this next group of people that typically hasn't been, that feels like those people are getting more concerned about it. So it seems like there's a bigger focus on this than there may be on the average 10% pullback, which happens every year, every other year. So
yeah, and pullbacks can and do happen. However, I would say, and this is me talking, not necessarily with the views of Oakworth Capital Bank and all that stuff, I will tell you that I think what makes this one a little bit different is that people were already starting to feel the economy slow down a little bit, not necessarily falling apart, but the economy was surprisingly strong last year for at least an aggregate. Top quartile, maybe, if not the top quartile, maybe the top quintile, top 10% of people have done very well over the last several years, according to all the official data, even if a lot of people feel as though the economy is passing them by. But even with that, feel a little bit of slowness. Feel the consumer is taking a little bit of a breather. Labor markets probably aren't quite as strong as what the government's been telling us. People can sense that stuff. And you have that sort of as a backdrop, and then you throw into the mix kind of a shotgun approach to economic and foreign policy that the administration has had. I haven't spoken to anyone personally that hadn't said something along the lines about Doge going, yeah, I'm kind of glad that they're doing it, but might not love the way they're doing it.
Yeah, some people are like, a scalpel would be nice.
Yeah, kind of scalpel would be nice. And the same thing maybe with tariffs going, yeah, I kind of want the Canadians to trade completely free with us, but you know, at some point you just got to let everyone know kind of what your thought process is against sort of the scalpel. In tomorrow's Common Sense, I'll be making an analogy, kind of like, hey, you've got a shotgun approach to what's going on here. When you're going moose hunting, do you want to take a 410 shotgun with number 9 birdshot or a 30-06 with 180 grain bullets?
Yeah.
And Sam, I know you're not much of a hunter. You want to take the latter. And so that's kind of where I think we are right now. A little bit of the first couple of weeks of the Trump administration, depending on which side of the aisle on which you sit, might have been a little invigorating. Feels as though maybe you got someone back in charge after not really knowing who was in charge the last 12 months. And even some of my more liberal friends will kind of admit it was a little concerning to them as well. A little bit invigorating in that regard. And now it's kind of like, all right, guys, how about 4 or 5 bullet points? Let's attack that stuff, and then we can go on to the next 4 or 5 bullet points.
You know, what's interesting, and you're right, you know, we've seen some cracks in some economic data, but the earnings expectations haven't come down. I mean, this
not
is
dramatically.
For a lot of areas, not at all. But we're seeing kind of indiscriminate selling, and I've said this week that markets can handle uncertainty, right? There's always some level of uncertainty. What they don't like is a big increase in that level of uncertainty. And I think you're getting the sense from people like, I don't know how this is going to happen. This shotgun approach you mentioned, this uncertainty to a certain point, especially maybe given the strong years that we've had for the past couple years, even though people may have not felt that things were that good. And so had people already on edge and they don't really know what's about to come. And, if you're on the left side of the aisle, you probably feel even more skittish about it. And so you have this just uncertainty. And I think it's, it can lead into the CEO confidence and what they're going to do. And,
So what you're saying is it's almost a self-fulfilling prophecy in some ways.
I think it is. Before the election, I know, especially around here, given the average political leanings of an Alabama citizen, people here were saying, wait till after the election and, confidence will come back to the real estate markets and rates will come back down and all this good stuff. And
well, that was wishful thinking.
It was very wishful thinking, and I
told people it was wishful thinking.
I did too. I told people that were waiting to lock in a mortgage rate till after the election
that's not really the way it works.
No, that's not the way it works. But so you have this wobbling maybe of confidence, and people that were waiting for this future confidence, and overall, I think that's the biggest part of it. We've seen multiples compress. People were willing to pay 22 plus times earnings for the next 12 months for the S&P, and that's pretty pricey. And we've talked about it
historically. Yeah.
It's a high bar. It doesn't mean it can't.
It's a high bar.
It doesn't mean it can't come to fruition that earnings growth is great and that multiple comes down in a great way because earnings grow. It just means that that's a high bar. And so there's more room for error. There's more things that can shake it when something is priced closer to perfection than it normally is.
I'm going to tell you, I've explained valuations very poorly to someone. But I think it got the message across to them. Anyone that's involved in finance will just shout me down on this. But they were having some confusion about high valuations. I said, it's like this. Imagine going to the grocery store and the bacon that you normally buy is like $7.99 a pound. $7.99 a pound is historically what you bought for it. Sometimes it's on BOGO, you get it for less, but that's about what you're in your mind you think is fair value for that bacon, $7.99 a pound. And all of a sudden, the grocery store is trying to sell it for $12.99 a pound. Well, you're probably not going to buy that. That's just priced too rich. It's just not going to do it. $7.99 a pound. $12.99, that valuation's too high. Well, right now, that bacon's priced at about $10.99 a pound. You might buy it, if you have to, but it's not where it needs to be for you. And like I said, it's not the world's best analogy, but that's in my way of thinking. It helps get it across for someone that's not in finance, kind of explain valuations. That's where we are, and you're right. It's the uncertainty. $10.99 a pound is kind of where we are. I think I'm just going to hold off until it gets back down to where I want it to be.
It's a confidence measuring thing because it's for the same dollar how much more or less you're willing to pay for it. And I think a part of the valuations, and I don't think that's the whole point of our goal to cover here, but a part of that is less about where it is right now and more about the direction you see it going
kind of the old Wayne Gretzky. Let's skate to where the puck's going to be.
Yeah, and so you see, a name could be trading, a stock could be trading at 50 times earnings, but if it's growing...
If it's going to 50%, then so what?
Yeah, and so, and like, if you think that's going to boom, you don't care that it's at 50 times.
If it's going to grow at 100%,
it's about the direction from where it's at right now and the price you're willing to pay for it to where that is going to go. So it's twofold, the value of that dollar now and the value of where that is headed. And so again, that just goes back to there is more possible, it didn't take much to get people off, shake their confidence a little.
Well, I will tell you, I'm going to take a step backwards here, and I'm going to explain to Sam. I just made an allusion to an ice hockey player by the name of Wayne Gretzky. Sam, Wayne Gretzky.
I know who Wayne Gretzky is.
Just it was a little bit before your time.
He was.
Yeah, there you go. I don't know. I mean, sometimes I have to clue you in on. Sometimes. I would tell you that when I take a look at really kind of what's going on in the economy, what's going on into the markets, and really taking a look at what we've seen from 2020 all the way through the end of last year, understanding that 2022 is a horrible year for the markets, but all told, people are much better off than they were in 2019 when it comes to the overall household wealth. And so when you see sort of what's happening in the world right now, see the uncertainty, as you said, and kind of wondering where the growth is going to come from. It always starts with a large, smart institutional money. They just take a little bit of money off the table. Just take a little bit. They bring their asset allocations back from an overweight stocks back to a neutral weight, and it puts some red ink in the markets. And then it's kind of like a FOMO, but going the other way around. It's just like market just starts selling and starts selling and starts selling off. And that's kind of what I think is going to happen here. In 5 years' time, I'm not worried about the U.S. stock market. Over the next 5 weeks, I might be, as people just have freaked out about what's going to happen in the short term as opposed to focusing on what's going to happen in the long term. And in the short term, as I'll tell everyone, I'm not exactly sure what the fuel is going to be to take the market up significantly from this point. We're a month away from the next earnings season, right? So the Federal Reserve likely isn't going to do anything next week at its FOMC meeting, and probably more than likely not at the next one after that either. I think we're into June before the futures market is priced in a rate cut. And then we're probably not going to see a sudden surge in overall economic activity from here. It doesn't mean that the economy is going to collapse. It doesn't mean that corporate profitability is going to collapse. It doesn't mean that the Federal Reserve is going to raise rates. We're just at a period of time where there's not a lot of fuel coming into the market saying, hey, go ahead and get your money in because this is right around.
Yeah, I still think the biggest focus right now, and I agree. We've talked about these cracks in economic data. We've talked about the low-end consumer, and
some of the data just doesn't make any sense.
Yeah, and that's all. Even if it's all true, I think what's going on right now is less about changes in economic data, less about earnings, which I think are going to be okay, and more about. I really just think it's uncertainty and what's going to happen over these next couple months. You're seeing volatility over the short term expectations be higher than the long-term expectations, which that's not normal. Normally you pay more for it out further because there's more unknowns the further out you go. And so this market is priced in this short term, doesn't know what's happening. And I just think that is having a profound psychological effect when it comes from the person who is focused on and talked about more than anybody else in the world being Donald Trump. And so I think that is the biggest driver because everybody knows who he is. Everybody knows what he's doing. Howard Lutnick, his Commerce Secretary, is on the news talking 5 times a day. Scott Bessent's out there. Everyone's out there with messages that are competing for time, and it's just this up and down, and tariffs are on, tariffs are off, and it's this unknown. And it's really showing up and priced in the short term. And so that's the fuel to me is just almost removing that.
Yeah.
Not anything to do about the economy suddenly picking it back up.
I think I'd have a better chance killing a moose with a 410 using number 9 shot than getting Trump to quit doing what he's doing right now.
Yeah, so that and so that's a good point though. Say if you think some level of this is going to happen for 4 years, what are you if people feel that, they're probably doing something about it.
Well, I don't think anyone thinks that this is going to last for 4 years.
No, not necessarily the tariffs.
But with tariffs and all that uncertainty, but I would tell you that because we've had such a good run over the last 2 years, people are going, okay, I can sit out the next couple of months. Now, if someone were to sit and be happy about it and then try to buy the dip or something like that. And I have to understand, a lot of money has flowed into the United States from foreign countries. And so when foreign countries get all kind of sideways with the United States due to personality conflicts, and we'll likely see that foreigners have taken money out of the U.S. economy in February and March. Otherwise,
I think we saw that out of Canada recently.
We saw that out of Canada. That's money leaving the U.S. bond market, maybe not quite as much, leaving the U.S. stock market and leaving deposits. And so the dollar weakens in that regard, and that's what I think you probably see a lot of. Probably see a lot of foreign investors selling their securities, which has, and then the mutual funds and institutional investors reallocating, rebalancing back, and now you're having a little retail freak out. And we're just now kind of in a period of time where we're just trying to find out what's a good buying opportunity. Is it now, or is it another 10%, 15%, 20% back?
Yeah.
And as I'm not sure if I sent you the same text as I sent Dave McGrath, it's kind of like today I was looking at it and taking a look at a few names which we've recently traded out of. Just sit there going, watching how easily these things are breaking through their 200-day moving averages with very little support any place close. Kind of gets me a little concerned.
Yeah, I talked with a coworker about this and about a few specific names that had some real bad real bad, at least reactions to the earnings reports.
Yeah.
And I feel like what you've seen a lot of, and this is very anecdotal, is after those is, okay, we caught this new level of support, and they start chipping their way back up.
That doesn't seem to be happening.
That is, at least in these names I'm thinking of, and I'm not going to mention them.
Please
but,
don't.
It's just continuing. I mean, this is weeks after, I mean, I'm talking 40, 50+% cut overnight, and just continuing down.
I'm just going to take this baby.
And these are,
you know,
I looked at the earnings reports. I was like, yeah, that didn't hit guidance.
Great.
But it wasn't. You know, these companies are still doing what they're doing, and it's not like
business model hasn't changed.
No, it's not like they're getting an unqualified audit or something like that. So, it's stuff like that has changed.
Yeah.
That I'm just. It's those kinds of feelings that you're getting, and again, if you're paying more for stuff, you expect more out of it.
If the bacon's $10.99 a pound,
better be as good as
it better be worth $10.99 a pound. Better be good.
Yep.
Otherwise, you're going to go back and buy the $7.99 bacon. I think. Is that one way of putting it?
It is.
Is it as bad an analogy as I think it is?
No, I think it's perfect for the first half of describing PE multiples.
Okay, what about the second half of it?
Being directions where it's heading.
I got you.
I think that's a big part when you're talking about what you're buying for an earnings multiple. But it's again, I think just this focus that has been on it is unique, and I would say it's one of the more focused and talked about 10% pullbacks that I can remember for something that nothing that we've talked about in economic data has drastically changed in the last 2 weeks.
Not drastically.
I mean, we've seen some trends, but it's not like, hey, oh my gosh, this was fine, and now it's not.
It's like, oh my God, we just jumped off the volume.
Yeah, we didn't see something in economic data that justifies a 10% pullback.
No.
That we weren't already kind of
seeing.
The
retail data hadn't been great, but it doesn't justify this level of freak out.
Yeah. So again, this multiple compression and earnings estimates have kind of ticked up just slightly, and it's sentiment. It's vibes has been the word that's been used over the last couple of years.
Animal spirits.
Animal spirits. They called it a vibe session, and when in 22,
animal spirits.
Yeah, when people felt bad about things and the economic data was fine, and so that's kind of where we are.
So that's where we are with the stock market. One more opportunity before we go. We're getting a little bit long here. Is what do you think about this rally in gold, my man? Do you think it's just the other side of that proverbial coin, no pun intended, but pun intended? Gold is up because confidence is way down everywhere else.
That's a part of it, and there's been a bigger focus on gold, and they over the long run they're going to be inversely related to real interest rates. That's where that inflation, people focus on inflation with gold, but. What's interesting to me is the massive amount of gold that's being imported back to the United States. I mean, it showed up in the trade data and the Atlanta Fed GDP numbers, and they had to go back and revise it because such a significant portion of it was coming just from gold being shipped literally on commercial airlines in the hull back to the United States, and that was in the trade data.
Hopefully not one of those airliners where the doors fall off of them.
Well, maybe it was just so heavy with gold that. But no, so I think I don't have the answer to why that is.
I mean, I guess it makes all the sense in the world. U.S. investors buying the jeebers out of GLD and GOLD and some of the other precious metals, exchange traded funds and mutual funds. We got to get the gold from somewhere, right? Gotta get from South Africa,
but even
get from somewhere.
I'm even talking about gold that is technically ours, that is held in vaults in Europe. I mean, even that's part of what was showing up. It's not a transaction of gold. It's literally moving something that is owned by me. It's like changing custodians. And so that's in the trade data?
It
was showing up in the trade data. The Atlanta Fed they issued a revision and had to back it out.
There you go. There you have it.
I don't know with gold.
I'm going to tell you, as long as this is what I think about gold. For a long period of time, while gold has been the original store value, the original investment, there really wasn't enough availability, enough supply for John Q. Public to really have a significant holding. It couldn't really invest in it. It was always the providence of central banks and the uber rich people like Scrooge McDuck.
Yep, swimming in
his gold coins, all that stuff. And it wasn't until the end of 2004 when a lot of these gold exchange traded funds and mutual funds really started coming out. So that's really when you've developed, in my estimation, a truly large liquid secondary market for precious metals.
Because it used to be the
coin shops and futures market.
Well, even before that, it was an investment for the ultra wealthy.
Yes, yeah, because it was hard to play.
Yeah.
And now you can play
It was a
much
big
more
chunk. It was a big asset class for the wealthy.
Yes, but you have to have some place to store it. I mean, it's one of those type things. I would say for the average retail customer, it's far easier to invest in gold, and as a result, you're seeing more people add that to their portfolios. And in times of uncertainty, more people buying GLD, GOLD, and some of the other funds out there. And as a result, you're seeing this stuff go up. And as people are buying the exchange traded funds, places got to go out and buy gold.
Yeah.
And the GLD's got to go out and buy it and put it in the warehouse wherever they store it.
Under the J.P. Morgan building in New York.
Well, there you go. Now I know, and so you have all that. So I think we're seeing, kind of what happens when the average American starts to feel uncertain about what's going on in the world around them. They have better access to gold than they previously had, better access to commodities and precious metals. And over the last couple of years, as we've seen sort of direction of the country polls head south and all that type of stuff, seeing gold take off. I think, I know the story about positive real interest rates. I know the story about inflation. They're all part of the same story. When push comes to shove, when people are feeling uncertain about things, stocks tend to go down, and things that have a long track record as being a store of value tend to go up in value.
Yep.
All right. Well, guys, thank you all so much for listening. We always love to hear from you. Also, if you have any comments or questions, please, by all means, let us know. You can always drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast out of your choice. As always, if you're interested in reading more, hearing more of what we got to say or how we think, you can always go to oakworth.com, OAKWORTH.com. Take a look underneath the Thought Leadership tab and find links to all kinds of exciting information, including links to previous Trading Perspectives podcasts, links to our newsletter/blog, Common Sense, that comes out every Friday, as well as links to our quarterly analysis, macro and market, all the individual components thereof. That's all out there underneath the Thought Leadership tab, as well as other pieces from our investment advisory services group. I guess it's more appropriately called the Advisory Services Group, headed up by Mac Frazier. He's got some good stuff out there, too. All right, Sam, anything else to talk about this uncertain time?
That's all I've got.
That's all I've got today, too. Y'all take care.